You take the Christmas field, Jim, you talk about naughty or nice in the real yield. What is a level of the real yield that keeps asset inflation going?
So I think where the Fed wants to go with this, because what really matters is what they think. And I'm going to talk about the policy, the real policy yield. So this is a nominal Fed funds rate minus inflation. I think that number is around 1.5%. So it's lower than what it is today. Wow. So if we look at nominal Fed funds today at 5.5%, and let's say U.S. inflation is at 3%, that means real policy rates are at 2.5%, which means that the Fed could cut 100 basis points just to get to their neutral level. So I know we've been talking, I've listened on the show, that yes, there's like 6 rate cuts priced in, but remember 100 basis points of those rate cuts is really just getting to neutral.
Right.
And they don't start really easing until they start doing more than 100.
I did some fancy math, Jim, in honor of your attending today on the standard deviation move of the Bloomberg Financial Conditions Index. We've gone from accommodative, and this is not Stan Fisher 101, it's Tom Keene 101, we're grossly accommodative. How does a Fed, their degrees of freedom just seem to have shrunk because of the market's statement on accommodation.
Right. So when we look at financial conditions, this is really a way for the Fed to gauge how their monetary policy is impacting the broader markets, and there should be some feedback mechanism from markets to what their policy is actually saying. So the way that I think about this is that if the markets are rallying, that's okay with the Fed. The Fed doesn't have to push back on a rally because they don't like a rally. That's not their job. Effectively, what they're saying is, can we get this rally? And can inflation also stay low? And if the answer is yes to both, then they don't care if the market continues to rally. They don't feel as though they have to push back on that. And right now, the look through to inflation going forward, as you mentioned in the UK, we had a downside surprise in inflation. Inflation is coming down in the US. As long as it does, then the Fed is okay with higher equity prices, tighter credit spreads, and even easier financial conditions, as long as we don't get inflation starting to move higher.